Hi, Warren William here for Smartest Data. Okay, this week I will cover economic stocks, sector rotation, and quick ideas on ETFs, and a review of the portfolios, the top 10 stock picks in 2023, the performance, and the CNBC final trades for the week finishing February 10th. So last week we put it into FinScreener. Okay, so let's go to the video. In economics, the key focus last week was a post-mortem of the Fed rate announcement on Wednesday, the 1st of February. Look, more rate rises to come. Maybe the pace will slow. The U.S. economy is performing well. It added 570,000 jobs in January, the most since July, and well above the market expectations of 185,000. Job growth was also widespread, led by gains in leisure, hospitality, professional and business services, healthcare. Meanwhile, the unemployment rate in the US inched lower to 3.4% in January 2023, the lowest since May 1969. So this week in economic data, inflation on Tuesday looking at 6.2%, with core inflation around about 5.4%. Wednesday, retail sales 1.2%, industrial production 1.1%. On Thursday, the PPI 0.2%, and Friday, import prices 1.8%. The key message is the US economy is performing well and a long way away from recession. This is exactly what the US stock market is indicating. Remember, stock markets are very forward-looking. So let's go to stocks, but before we do, if you like these videos, please like and subscribe. It really does help the channel. Okay, last week in the stock markets, the Federal Reserve really dominated market activity over concerns that policymakers will remain hawkish for longer than expected, and the US benchmark Treasury rate, 10-year, increased to the highest level in more than a month. Last week, the S&P posted the first weekly loss in nearly 2 months, as investors may have concerns that the US earnings appear to be on the light side, as less companies than usual are beating Wall Street estimates. Stocks finished on the week: S&P 500 minus 0.7%, Dow Jones flat, and the NASDAQ down 1.8%. I do not find earnings a key concern. Companies are going through a period of restructuring, labour, and also on the balance sheet, and guidance could be more favourable towards mid-year. In terms of the earnings schedule, significant reports this week will come from Shopify, Deere, DraftKings, and Coca-Cola. Okay, so let's take a look at sector strength and weakness in the S&P 500, still indicating the formations of a bull market. So let's take a look at the heat map for the S&P 500, and this is based on stock size. So you can see Apple there up 16%, Microsoft up 9.9%, Google up 7.5%, and then we can look down and we can see Nvidia and Telstra are up 68% and Nvidia up 52%. So they've performed extremely well so far this year. Then if we go on to the individual sectors, here we are in the consumer discretionary sector. So Amazon, Telstra, they've been the top performers. If we move on to consumer staples, been negative so far this year, but this is a classic defensive sector. This is probably something you'd expect. Then if we look at oil and gas energy, so ExxonMobil up 3% for the year, 3.67%. Then the financials, so we've got Berkshire Hathaway, JP Morgan, Bank of America, Wells Fargo, Morgan Stanley done well so far this year. Then if we go into healthcare, again, this sector is typically a defensive sector, so it's been quite negative this year. Moving on to industrials. So industrials has been very much a mixed bag. This is a sector which we could expect later in the cycle once the market gains more upward momentum. If we look at information technology, Apple, Microsoft, Nvidia have done extremely well. The materials sector, this is a later cycle sector. If we look at real estate, it's done, I think, surprisingly well so far this year. And then if we look at communication services, Google have done quite well. Meta up 47%, Disney and Comcast up 8%. Then finally onto utilities. This is typically a defensive sector, so everything's been quite negative, with Nextra Energy down 12%. Okay, let's go over to ETFs and take a look at the increasing demand for buffer ETFs. The rise in the buffer ETF, the exchange traded funds, offer investors exposure to a wide portfolio of securities whilst tracking a particular market index, industry, or commodity, as ETFs do. They do differ from many ETFs as they are designed to offer protection to investors from market downturns. These ETFs typically employ a variety of investment strategies like options to lower the portfolio's downside risk. Investors can use them as a tool to protect themselves from market volatility or to make money in a low-yield environment. It's crucial to keep in mind that while buffer ETFs can aid in lowering downside risk, they also may restrict potential gains in rising markets. Thus, you are taking on equity risk but capping the upside. Their performance can largely vary depending on the particular strategy used. Before investing in a buffer ETF, as with all investment products, it's critical to have a thorough understanding of the underlying strategy, potential risks, and reward. The American Industrial Renaissance ETF is an ETF which is managed by First Trust Portfolios. The investment strategy is designed to track the Richard Bernstein Advisors American Industrial Renaissance Index. The index is designed to measure the performance of small and mid-cap US companies in the industrial and community banking sectors. The ETF will normally invest at least 90% of its net assets in the index's constituent companies. Specifically regarding banks, they'll be from the US states considered to be traditional manufacturing hubs. Bank stocks will be limited to approximately 10% of the index at rebalance. Dimensional US Small Cap DFSV ETF is run by Dimensional Fund Advisors. The ETF was launched in February 2022 and the investment strategy is designed to track the Russell 2000 Value Index. The objective of the Dimensional US Small Cap Value ETF is to achieve long-term capital appreciation by investing in small cap stocks. Equity and fixed income allocations are determined by the fund's categorization. Sectors are classified according to the GICS sector classification. Characteristics of the fund: the AUM under management is 1.3 billion and the aggregated price to book ratio is 1.27. The Allianz US Large Cap ETF is a buffer fund, JANW, bringing hedging capabilities to the retail investor. Current cap 10.28%, current buffer 21.42%. The concept of a buffer fund provides downside protection for the many retail investors who are over the roller coaster ride when investing in stocks. A typical investor could be one with a conservative mindset or an investor near to or in retirement. For these investors, it can be hard to stomach market drawdowns. The driving force behind market drawdowns over the past 20 years have been varied: dot-com bubble, GFC, and COVID. In the end, the driving force doesn't matter. The spike in volatility has made many investors more risk adverse. Okay, so let's go over to the portfolios and take a look at the top 10 for 2023 and the CNBC final trades portfolio from last week. Okay, so here we are in the portfolio, the top 10 stock picks, which we put in at the beginning of the year. And so far, the portfolio has done quite well, up around about 13.4% year to date. On the strong buys is Goldman Sachs, Wells Fargo, Amazon, Google, Nvidia, Qualcomm. On the buys, we can see there Bank of America, Verizon and Apple, and ExxonMobil is coming in at a neutral. Okay, on diversification, 27% in financials, 27% also in technology, and 18% in communication services. So just onto portfolio correlation. As the market strength has weakened a little bit over the last couple of weeks, the level of correlation amongst the individual stocks has also decreased. If we look on to analyst consensus, there's the consensus from analyst price targets, about 43% upside from here. And as we can see on strong buys, still remains around about 85% of the total portfolio. If we look down to see what part of the portfolio has done well, Nvidia's had a particularly good year so far, up 47%, Qualcomm up 22%, Apple up 13%, Amazon up 15%, Wells Fargo 15%, Google 5%, Goldman Sachs 7%, Bank of America just 3.5%. So here we are in the new portfolio for the CNBC final trades for the week finishing February the 10th. Okay, so if we take a look, clearly there's flat performances in the portfolio has just been put in today. If we look at the strong buy, there's Google and Uber. On the buy, we have Abbey, Citi, Daliher Corporation, and Nextra Energy. Okay, regarding diversification, healthcare, there's 3 stocks for 30%, technology 2 stocks for 20%, and financial services 1 stock at 10%, and then also communication services 2 stocks at 20%. We can see here the level of correlation. The portfolio is actually quite low. If we move on down to the various sectors, so in healthcare we've got Abbey, CVS, then down onto technology and software, on semiconductors and Uber Technology, down into utilities, NextEra Energy, Financial Services Citi, Consumer Cyclicals Starbucks, and Communication Services Alphabet and Paramount Global. So regarding the analysts, there's around about 8% upside on the analyst recommendations so far. I would say this portfolio is quite a conservative portfolio. This portfolio is one to be looked at if you expect the market fluctuations and possible downside over the next couple of weeks, couple of months or so. That's it for this week. Remember, always think and question about your investments.